morning, ladies and gentlemen, and welcome to Courtiers 2022 Client Seminar. Hello to everybody here personally, and hello to everybody virtually. My name is Jamie Shepherd, and I'm CEO of Courtiers. Today we have a packed and exciting agenda for you. Your speakers will be James Timpson, Jake Reynolds, Katie Crook, and Gary Reynolds. Following Gary's presentation, we will collect in your question card, and I'll invite all of the speakers up to the stage and put your questions to the speakers. So, ladies and gentlemen, may I invite our first speaker to the stage, James Timpson. James joined us from university. James has a first in mathematics. He was one of the youngest contestants ever to appear on Countdown at the age of 18. When we said to James, did you get all the maths questions right? He just looked at us blankly and said, well, of course I did. So, ladies and gentlemen, James Timpson.
Thanks very much, Jamie. Good morning, everyone. Great to see you all here. Now, if you were at last year's seminar, you may remember during the Q&A, Jamie asked each of us if we could write to Santa, what would our Christmas wishes be for next year's markets? And I said, after all the volatility that markets have endured throughout the pandemic, it would be nice if we could see things calm down a little and for volatility to go back to lower levels. Well, I think my letter must have got lost in the post. Either that, or I was a very naughty boy last year because Santa did not give me what I wanted. We start with this chart, and this shows the number of times each year that the global stock market moves more than 2% in a single day. And most of the time, this is quite rare. But then in 2020, the year of the pandemic, it happened 40 times. And this year has almost matched that. There have been 28 days this year where the global stock market has moved more than 2% in a single day. Next, we've got market sentiment, and this shows the proportion of positive days versus negative days in the market each year. And in most years, we get more green days than red days, i.e. the market goes up more often than it goes down. This year, though, we've had more negative days than positive days. And in fact, it's actually been slightly worse than in 2008, the year of the financial crisis. So where has it all gone wrong? Well, let's go back a year ago. If you may remember, this time last year, everyone was worried about the Omicron variant. That feels like a lifetime ago now, doesn't it? But even though that particular variant turned out to be fairly mild, the pandemic as a whole was still having a huge impact on stock markets, with all sorts of disruptions to supply chains, resulting in an excess of demand over supply. And this was pushing up inflation. And this time last year, inflation in the UK stood at 5.1%, which seemed quite high at the time. Over in the US, inflation was rising even faster, and by January this year, it had reached 7%. So central banks responded by pushing up interest rates. And when interest rates go up, equities tend to fall. And in just the first 7 weeks of 2022, the global stock market had fallen 7.4%. And when stocks are falling due to rising inflation and interest rates, it tends to be more expensive companies, such as those large tech stocks, which tend to get hit the hardest. For the UK market, which has very little exposure to those sorts of companies, that was only down 0.3%, whereas the US market, which is practically dominated by them, that was down 8.8%, with Microsoft among the biggest fallers, having lost more than 14%. So markets have gotten the year off to a shaky start. Then, of course, war broke out in what can only be described as one of the biggest conflicts of modern times. And no, I'm not talking about Will Smith punching Chris Rock at the Oscars, momentous though that was. This is, of course, the Russia-Ukraine conflict, which actually dates back to around 2014, back when Crimea was annexed. But it escalated significantly on the 24th of February this year, when Putin launched what he described as a special military operation to demilitarize Ukraine. In other words, he launched an invasion. Within minutes, cities in Ukraine were being attacked. And markets did not react well to this. FTSE 100 lost nearly 4% in a single day. European equities were down around 3.5%. But the biggest fallers, perhaps unsurprisingly, were Russian equities. So this is the MOEX index, which tracks stocks on the Russian stock exchange. And on that first day of the invasion, this index declined 33.3%, easily its biggest one-day fall on record, as investors braced themselves for a series of very heavy sanctions to be placed on Russian companies. After a couple of days of huge volatility, the Moscow Stock Exchange was shut for an entire month, the longest it's been closed since the fall of the Soviet Union. But it eventually reopened, and since then, they've not recovered. Year to date, Russian stocks are down 43%. We also saw a big fall in the Russian ruble. Within just a couple of weeks of the invasion being launched, the currency was down 46% against the US dollar. However, unlike stocks, the currency bounced back. And it actually bounced back quite strongly. It even reached a 7-year high in June this year. And this is partly because Russia has imposed strict limits on how much investors can take out of Russia. And this limits selling of the ruble. But it's also because Russia has made a huge profit this year on its fossil fuel exports. And that brings us on to the surge in fuel prices. And even before the events of this year, these were rising rapidly. So here we've got the natural gas price throughout 2021. And in last year's seminar, I mentioned that lots of gas providers in the UK were being forced into bankruptcy because of this spike in prices. But it turns out that the world's largest provider of natural gas launching a huge invasion doesn't exactly help the situation. Here's the chart with 2022 added, and we've seen even bigger spikes, with the gas price reaching its highest level since the financial crisis. It's been a similar story for oil, of which Russia is the world's second largest provider. Within days of the invasion, the price of oil surged above $100 per barrel for the first time in nearly 8 years, due to fears that Russia may cut off its vast supply of oil to countries which rely on it, particularly in Europe. We also saw big rises in agricultural commodities such as corn and wheat, and this pushed up food prices. All of this combined simply resulted in even higher inflation. So here's the UK Consumer Prices Index. And in October this year, it reached 11.1%, its highest point for over 40 years. And because inflation has been such a huge topic this year, let's see what the ONS has been adding to the basket of goods and services which it uses to track inflation here in the UK. So just like last year, I'm going to put some items on the screen, and can you guess whether these have been added to the basket this year due to current trends, or have they been taken out? So in or out. And we start, of course, with frozen Yorkshire puddings. Do you think those are in or out this year? These are in. And this reflects a rise in consumer convenience cooking at home. So what about meat-free sausages? Are these in or out? Oh, these are in. And this is simply due to a rise in vegetarian diets. Next, we've got donuts. Are they in or out? Yeah, sadly, these are out. Sales have declined, and this has been attributed to a reduction in office working since the start of the pandemic. So now we've got dog collars. Are they in or out? Yes, these are in, and this reflects a rise in pet ownership in the last couple of years. Next, we have coal. Is coal in or out? Yes, coal is out, and sales of domestic coal have actually been banned in the UK from 2023. Next, we have sports bras. Are they in or out? Yes, these are in. This is due to a rise in spending on sports clothing since the start of the pandemic. And finally, dictionaries. Are dictionaries in or out? Yes, these are out. Sales have declined, and this is simply due to the rise of the internet. And speaking of dictionaries, the Collins word of the year for 2022 is permacrisis. This reflects the current state of living through war, through high inflation and political instability. Now, I believe I've covered 2 of those already. And to be honest, I'm not sure I've got enough time to cover the third, because it's actually my turn to have a go at being Chancellor in half an hour, so that should be fun. But it does bring us on to government bonds and fixed income in general. So I mentioned earlier that because of rising inflation, central banks have been pushing up interest rates. And when rates go up, bond prices go down. Here we've got the last 3 years of UK gilts, or government bonds, and after 2 years of remaining relatively stable throughout a global pandemic, this year they've absolutely plummeted. Year to date, they're down 21% due to rising rates. Even worse for longer dated gilts, those with more than 15 years to maturity, they're down 35% year to date. And you'll notice that the gilt prices bottom out in the days following that infamous September mini budget, during which Kwasi Kwarteng unveiled so many tax cuts. Gary Barlow must have thought Christmas had come early. Less happy were those looking to renew their mortgage, for instance, and also those looking to purchase foreign currency, because one of the other big market movements following that budget was a further reduction in the pound, which had already had a volatile year leading up to it. But in the days that followed, it actually reached an all-time low against the US dollar. It has since recovered to around $1.20, but it's still down 11% year to date. So following the very negative reaction to that budget, Kwasi Kwarteng was dismissed as Chancellor after just 38 days in the role. A few days later, Liz Truss resigned, making her the shortest reigning Prime Minister in UK history, and also causing an unexplained rise in the popularity of lettuce. But just when you thought UK politics couldn't get any more bizarre, you see the former health secretary eating a camel penis on primetime television, which is not a sentence I thought I'd be saying at the start of the year. But it's a year that most investors are going to want to forget. So in the last 12 months, global equities are down 8%, for having their worst year since 2008. And as for bonds, it's been such a bad year for fixed income that James Bond is thinking of changing his name to James Alternative Asset. It's been that bad. But we must now move on to fund performance. And clearly, it's been a difficult year for everyone. But let's see how your Courtiers portfolios have done in the last 12 months, starting with the multi-asset funds, Cautious, Balanced and Growth. And I'm really pleased to say that the Cautious Risk Fund has actually achieved a positive return of 0.5%. Balanced Risk Fund is down just 0.5%, and the Growth Fund is down just 2.1%. Those grey bars are the IA peer groups. They show the average return of funds with similar risk mandates. And you'll see that the Courtiers funds have been really defensive this year. And we've achieved that by maintaining low interest rate risk. So the funds have not been heavily exposed to that big decline in the bond market that we've seen. So we've also had minimal exposure to those large tech stocks, which I mentioned earlier had been particularly exposed to rising inflation and interest rates. And also throughout the year, we've been increasing exposure to real assets such as infrastructure, which tend to act relatively defensively in periods of high inflation. So we're really delighted with how the multi-asset funds have performed this year. Next, we have the equity and bond funds. The UK Equity Income Fund is down 6.6% this year. And although it's been a great year for the FTSE 100, which tracks the largest companies in the UK, it's been much tougher for medium and smaller companies, both of which are down around 13%. And of course, the UK fund has exposure to both of those. The Global Equity Income Fund is down just 0.3%, so it outperforms the MSCI World Index, which tracks global equities. And finally, despite it being a really terrible year for gilts and bonds, the investment grade bond fund has actually achieved a positive return of 1.8%. And this is because throughout most of the year, it's been almost entirely invested in short duration, lower risk investment grade bonds, which are much less sensitive to rising interest rates. So we're really pleased with how all of the Courtiers funds have performed this year. Now, it may have been a volatile year, but nothing will stop me from ending the show with play your markets right. And you know how it works by now, don't you? I'm going to put some market returns for the year on the screen. Can you tell me whether the next one is higher or lower than the previous one? So we've just seen that the UK, or the FTSE 100, is up 11.3% this year. What about European equities? Are they higher or lower than the UK? They are lower. European stocks are down 2.5% this year. What about the US? Higher or lower than Europe? It's lower. They're down 9.2% this year, partly due to its heavy concentration in those large tech stocks. Next, we've got China. Higher or lower than the US? It's lower. It's been a really tough year for Chinese equities, partly because China has had to endure several more lockdowns throughout the year, but also due to negative reaction from President Xi Jinping's controversial third term in office. So now we've got Shell, the big oil company, higher or lower than China? Let's have a look. Much higher. It's been a great year for Shell's share price, up 55%. And earlier this year, it reported record earnings amidst rising demand and rising fuel prices. So what about Amazon, higher or lower than Shell? I've given you a couple of clues to this one. It's not even close. Down 44.9%. And Amazon has actually had to scale back its operations this year after expanding massively throughout the pandemic, because as lockdowns have eased, shoppers have returned to physical shopping. So next we've got Tesla, another big US name, higher or lower than Amazon? It's quite close, this one. It's a little lower, it's down 49%. And it took a big hit in October when Elon Musk finalised his Twitter deal, with many analysts predicting that his focus on Twitter could have a negative impact on his Tesla operations. So next we've got Bitcoin, the cryptocurrency, higher or lower than Tesla? Ouch, it's down 70.1% this year. It's been a really volatile time for cryptocurrencies, made even more so last month by the closure of FTX, one of the biggest crypto exchanges in the world. So that's Bitcoin. Now, how about Titcoin? And for those of you who weren't here last year, Titcoin is a genuine cryptocurrency developed around 8 years ago for the adult entertainment industry. And yes, that is its real logo. Higher or lower than Bitcoin? It is actually slightly higher, but it's still down 30.3% this year. So it's lost nearly a third of its value. I suppose investors will have to take it on the chest. Take it on the chin. So let's move on, shall we? And we finish with Vladimir Putin's approval rating. And this is based on surveys of Russian citizens. How much has it changed this year? Higher or lower than -30? It's gone up. It's gone up 12% in the last 12 months. His approval rating currently stands at 79% among Russian citizens. So there we have it. Thank you all so much for listening. I look forward to speaking to some of you later on. But for now, if you don't mind, I'm just off to go and tidy my room and maybe help an old lady cross the road in the hope that Santa gives me what I want next year. Thank you very much.
Ladies and gentlemen, James Timpson. Now, I'm very pleased to invite Jake Reynolds to the stage. Jake is now 5 years into his 14-year apprenticeship to take on the mantle of Gary's role as Chief Investment Officer. Jake spent 9 years at Schroders in the emerging markets desk as one of the fund management team. And 5 years ago, we managed to secure his signature and drag him to Courtiers. But he did come skipping through the door. So may I invite Jake to skip up here and tell us all about his presentation.
Yes. Great to see you again. So today I'm going to be talking about active management, but specifically it's about active risk management, making sure we allocate your capital to where the risks are rewarded and definitely not where they are lopsided. Now, it's been a difficult year and it's thrown up some really interesting challenges, but some of those challenges we've been positioned really well for. And I would like to pull up one of James's charts to shed some light. I want to shed some light on today, and it really is the differences between that we see in the Courtiers peer group and how we have done this year, what has actually been going on behind the scenes to create that gap. But one of the starkest things I think is on this chart is the fact that the supposedly cautious peer group, that's made up of hundreds of cautious funds, on average has underperformed your growth peer group that are going to be about 100% in equity. Now this shouldn't happen, and it has happened this year, and I want to show you exactly why that happened. So to start with, we need to go back to the days of this man. Now, it's not Mel Gibson, it's William Wallace. And the reason is, 2 years ago, we stood in front of this chart, which is the 700-year history of interest rates, all the way back to days of William Wallace Braveheart. And we showed that in no point in history had interest rates been lower. But we also said that we expected them to rise. Now, since we were on our feet in December 2020, interest rates have started to rise very quick at some points, very, very quick in September this year, in the aftermath of the budget, which caused all manner of issues in the pension market. But why has this caused that big differentiation in the cautious peer group? Now, as James alluded to, it's because they hold fixed income investments, they hold obligations of payments in the future. Now, we're very tuned in to the effects of rising interest rates on our monthly costs through mortgages, loans, etc. However, what's less well covered is the devastating impact that rising interest rates can have on the value of future payments we receive. Now, to bring this to life, I want to I'll give you an example, and I want to ask you a question. And the question is, how much would you pay me today to receive £100 in 100 years' time? Now, hopefully, over the last few decades, we've trained you well, and you're thinking not very much. But we're going to start where markets were 2 years ago at 0%. So near zero interest rates in the UK, zero across in the EU. And the value of that today that you would be willing to pay me for that today in 100 years' time would be £100, which seems ludicrous because you need to be rewarded for that being for sacrificing that money for that period of time. But that is exactly the environment we are in. Now, what I want to show you is what happens when market rates start to rise. Now, if we just rise interest rates to 0.1%, suddenly the current value that you would want to pay me goes down 9.5%, only at 0.1%. At 0.5%, you only be willing to pay 40%. At 1%, you're down over 60%. 2%, it's down 86%, and at 4%, the historical value of interest rates globally, if we'd made that deal, if I'd been lucky enough to receive that £100 up front and I was going to pay you back in 100 years, I'd only have to spend £2 to buy myself out of that obligation. Now, if we plot this on a chart, you can see how the exponential decay that we get when interest rates rise on the value of fixed payments in the future. Now, this is the devastating impact I alluded to when it goes down so rapidly, and the reason it goes down so quickly is because of the power of compounding. Whilst it's only one payment in the future, the alternatives that you would have available to you is earning interest on interest in the banks. That power of compounding that still is how we value bonds and we value fixed income instruments. So you can see how quickly it falls when interest rates start to rise. Now, this is exactly the what we try to harness when we try to get your assets into the hardest working elements, asset classes like equities, to try and earn a good rate of return over the long run, so we can harness that power of compounding. So you're riding a curve up, but when you buy those fixed payments in the future, you will be going down. You'll be ultimately experiencing it on the other side. Now, you don't have to take my word for it. The power of compounding, you can take Albert Einstein's compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Now, as I said, if we'd made that deal at 0% and then interest rates had gone back to 4%, you would have paid it, but hopefully we try to earn it. But you may think, oh, I get compounding, 100 years is a bit far-fetched. But actually, that wasn't a fictional example. This is exactly what the Austrian government did in 2019 and 2020. They were issuing zero coupon 100-year debt. And these issues were over 4 and 8 times oversubscribed. So people were rushing to buy these things, and exactly as the example I gave, except it's in euros. Back in the zero interest rate environment, these bonds were trading at 100 euros, and interest rates have only moved to 2.5% in Austria, so still below long-term averages. And this bond has lost 92% of its value. It's now trading at 8 euros. Now, why were people buying this stuff? Well, the yield curve is upward sloping. Now, what I mean by that is that as interest rates went really low, people went further and further into the future. They bought longer dated debt. And normally you are rewarded for taking that sheer risk over volume of time. And to bring that to life, you only have to think of the fact that Austria is only just over 100 years old. It emerged out of World War I, and it still had occupation by Hitler, Allied occupation, decades of neutrality and the EU ahead of it. So you need to be rewarded for that. And people saw it as their obligation to try and get a positive return. Our peers saw it as their obligation to get a positive return into the portfolios on the fixed income element. And as interest rates kept going to zero, nearer and nearer, they got further and further out and bought longer and longer term debt. Now, we didn't sit on our hands and do nothing. We started up a relationship with King & Jackson, who was a primary participant in the T-bill auctions. That this is this government debt that's on 1, 3, 6 months. It pays a good yield, but we did it to try and get positive yield, cognizant of the impact that long dated debt can have on the portfolio. It's not the only thing we were doing, and obviously highly detrimental to our peers. Now, it's not the only part of the portfolio we've been hedging on. Since 2016, the pound has been decreasing. So that's also something that we need to hedge in the portfolio. On some metrics, you recall James's chart, it was down at $1.04 back in September. We were writing about it then, looking at different metrics, different ways of valuing it. On some metrics, it was 40% undervalued. If the pound were to rise rapidly, all your foreign assets would decline in value, because the only currency that we care about is the currency that we spend money in, which is GBP. So pound sterling. So we've been hedging the currency, and that's been helping us, particularly in November, as the pound has risen. Now, similar to the Einstein quote, you don't have to take my word for it, the pound is undervalued. Complex investors have been buying UK companies. UK companies are a big discount to foreign companies at the moment. But not only that, the pound is also discounted, so you get a double kicker. Since 2016, you can see the amount of UK companies being bought by foreign entrants has tripled. And we have benefited from this. Over seven companies have been bought out of the UK portfolio over the last few years, often getting a 40% return in one day. Most recently, we had a sausage casings manufacturer called Devro at the end of November that was bought by a German agricultural conglomerate, went up 60% in one day. So we've been benefiting from buying value companies that other people have recognised, and obviously the pound has allowed these foreign companies to pay a big premium for them, hoping that they get the double kicker on the other side. There's one man's risk is, I guess, another man's opportunity. So that's not the only thing. We're constantly looking at portfolio, and the equity side, as James said, we've been out of big tech, and we've talked a lot about that over the last couple of years, and that has really defined our last year, and it's really been defined by what we haven't been invested in rather than what we have been invested in. But we have been investing, we've not been, like I say, sitting on our hands. And so what I'd like to do, just to finish off, is do an exit through the gift shop, to bring to life, those equities. Talk about that compounding. We talk about doing the hard yards. It's the equities that are going to do it. They issue products. So do a little gift list to bring your portfolio to life. So the sausage casing manufacturer is gone. We sold it after it was up 60%. So take your pigs and blankets off the menu this year. If you've got kids that need consumer electronics, we've added Lenovo to the portfolio this year. We also built a position in HP over the last couple of years, just before Berkshire Hathaway, Warren Buffett did. So nice to know we're in good company when we're selecting our stocks. And lastly, for those relatives that have been naughty and not nice, maybe a lump of coal. Now, James alluded to domestic coal being banned, but this is metallurgical coal from a company called Arch Resources in the US, currently paying a 30% dividend, and it's benefiting from that revamp in infrastructure as coking coal is used in steel production. Now that won't be for everyone, and a little teaser towards Katie's presentation is there are alternatives available now. But to finish off, I would just like to thank you for trusting us with your capital again this year, and I'll be around for the Q&A, so anything you want to ask, please feel free and at the lunch. And to finish off, I'm wishing you a Merry Christmas and a very Happy New Year. Thank you.
Ladies and gentlemen, Jake Reynolds. Well, I have pleasure in inviting Katie Crook to the stage. Katie joined us a number of years ago, and initially she joined the power planning team, the people who write the technical reports for you that you receive. And Katie saw an opportunity arise in the investment team and opted to transfer to the investment team. We have 123 people looking after your money for you and your financial affairs and your tax affairs. And we manage over £1.1 billion. And I'd just like to take this opportunity to say thank you for entrusting us with that money. So part of Katie's role, as well as being an investment analyst, is to police. And Katie polices to ensure that we follow our ESG remit, but also she polices the EVE fund. And Katie's going to explain to you what EVE is. Ladies and gentlemen, Katie Crook.
So for those of you that were here last year, we went over a review of how we increased our process on monitoring ESG factors. So that's environmental, social and governance factors within the funds. This year we wanted to do something a bit bigger and a bit better. So we went about constructing the Courtiers Ethical Value Equity Fund, or EVE for short, and no, we're not launching an add-on fund. So why did we actually bring about the Courtiers Ethical Value Equity Fund? We've run an ethical strategy since 2005, which comprises of third-party funds. When we reviewed these at the beginning of the year, we noticed you could either have dark green screen stocks, which means they've got exclusions like fossil fuels, or you could have growth stocks. For many of you that are aware, within our portfolios, we tend to tilt towards value equities. So when we were looking at these third-party funds, we thought this isn't going to work for us. It doesn't follow our investing process, and actually we can't have the overall say of what goes in the fund. So we decided to create our own, and that brought us to the creation of EVE. So why has EVE now only been made possible? Well, over the last few years, there's been an increase in sustainability data, so we can really drill down and assess the characteristics of companies. So that's past behaviours, future behaviours, carbon intensity, all those metrics we can look at. But it also allows us to ensure certain things don't go in the fund, which is the main rationale behind the construction of EVE. We know there's a certain set of investors, some of them may be yourselves, that don't want certain items and areas held in the fund. So we wanted to make sure if it said it on the paper that it's not going in the fund, it's definitely not going to be in the fund. So EVE is a two-stage process. You've got an exclusionary screen that's done on data screening, and then we have an analyst overlay as well. So your first set of exclusions are 12 blanket exclusions. So these are not permissible investments of the fund. So you won't find any of these areas in the fund. So to give you a bit of background, there's 12 of these. You've got adult entertainment, you've got animal testing, you've got armaments, fossil fuels, fur and specialty leather, GMO products, intensive farming, nuclear, palm oil, pesticides, predatory lending and stem cell research. These may look pretty simple, black and white when you first look at them. You're like, oh, animal testing, that's got to be, you know, just one block of things. Not that simple, not that straightforward, I'm afraid. You may go to your supermarket, you'll pick up a bottle of sauce. If you've got any sauce or cereal that's got fibre products in it, that fibre has actually been tested on animals because it has to be tested under REACH legislation, but it won't tell you that on the bottle or on the product. So we wanted to ensure that we can actually drill down and check those things aren't in the fund, which is why it's slightly more complex than it first seems, but there is definitely none of these areas in the fund. The next layer we've got on there are revenue cap exclusions. So we're not saying these are wonderful areas, but we didn't want to penalise businesses where they have a small allocation to these areas, but it's not their main revenue driver. So you've got tobacco, alcohol, gambling, and non-weapon related military support services. So alcohol and tobacco are sold by supermarkets. That's not their main revenue driver, so we've capped that at 10%. Gambling and non-weapon related military support services, also 10%. The non-weapon related military support services, biggest exclusion in terms of word of mouth, but the reason for that is for things like communication services companies. So one example is BT. They do lots of communication. They also do a lot of CCTV that is used by the military. It's not meant to be their main business driver, but it is used by them. So again, we've put it as a revenue cap. Following this, we have a third level on the exclusion screens, and these are risk exclusions. They're scores that go from low to high. Low is on your favourable side, they're doing them well. High and severe, they're not doing these areas so well. So the 3 risk scores, you've got your ESG risk score, so that's risk to the business from environmental, social and governance aspects. You've got your carbon risk score, and that's risk to the business from transition to a low carbon economy. So that'll look at things like carbon intensity and their scope of emissions, so 1, 2 and 3, so what their products actually do and also the emissions by the end user. And you've also got controversies, so that's past business behaviours, how they've managed them, how they're improving and what they're doing to avoid those issues in the future. So following this blanket screen, we then needed a bit of common sense. So we've got our analysts upstairs, well, in Henley based upstairs, but still upstairs. They'll look over these areas and they'll go, does this actually make common sense? So they'll look at environmentally destructive industries. Currently, there are no miners or airlines in the portfolio. That's not saying there won't ever be, but at the moment, the technology is not in the right place. They'll also look at things like human rights records, as well as whether they're on any UN sanction list, sorry. So they'll basically just look at all the aspects that we've put together from the screen and try and make sense of those. But why have we done that? Well, to bring that sort of to light a little bit, if you take M&S, which is held in the E Fund, they were praised for putting, I think it was around 1,000 beehives on 25 farms around the UK. And they were like, okay, we're going to help with biodiversity, try and repopulate and do a bit of good for the environment. On the other side of the fence, you had the conservationists coming along going, well, really, that money should have been employed into restoring habitats and building better homes. So for them, they can't win. You know, that's not an awful action. It's not a brilliant action. It's either side of the fence, but we don't think that's rationale for chucking them out of the Eve Fund. Another example of this is Taylor Wimpey, which is held in Eve. They do buildings, new homes, and they've started using bee bricks in their buildings. Bee bricks are like normal bricks, but they have small little holes in them. So the solitary bees who don't like to hang out with other bees have somewhere to go and live. That seems like a great initiative. Again, not everybody agrees. Some people think that, well, the holes can get filled up with mites and disease and you end up killing off the solitary bees. Again, you've got no perfect solution, so it needs a bit of common sense, which is what our analysts apply to that. So the fund has been constructed. It holds between 30 to 50 equity stocks. Some of these you may recognise from the existing UK or global fund. There is some overlap, but there's also some completely new holdings in here. Unfortunately, Vodafone doesn't make it in because when we were researching them, turns out they've got an adult chat line that makes 5% of their revenue, so they couldn't go in the fund. We did notice, though, when we were doing this fund, is there would be restrictions on these sectors that we could hold. One of those would be energy, mainly due to the fossil fuels, and the other one's going to be healthcare due to animal testing. However, we've done some digging, done some research, and we do have allocation to both of these within the fund. The first one is to the energy sector, which is Bluefield Solar Income Fund. For those of you that are invested in the multi-assets, this has been held in there since May. Because it's not an equity, our analysts had to review it separately, but they've done a stringent review. So through all their ESG policies, how they act on them, what they actually do. When there were controversies arising to polysilicon in the supply chain, they went through and thoroughly reviewed that. And we're happy that these guys actually stick to their policies and don't just write them up in black and white. So that gives the fund the energy allocation. The next one is a healthcare allocation. So this is Premier. Premier is basically an analytics company, and they look at improving patient outcomes while also reducing costs, not just reducing costs to get people through the hospital quicker. So where they've been quite useful over the last few years is they've partnered up with a company called Steripath, and gone into one of the hospitals in West Virginia. And they've looked at their rates of false positive testing. So anyone who gets admitted in the US has to be tested because sepsis is a leading killer of readmission and deaths. They ran these results through their systems, and actually they found a way to reduce those false positive tests down from 4% to 1%. Not only does that benefit patient care in the sense that they don't have unnecessary antibiotics, which the World Health Organization has leaded as one of the greatest threats to ourselves, because once we've used them too much, we've lost them. But they've really improved patient outcomes, and they're also a good allocation to the healthcare sector within our fund. So that's just a brief overview of Eve. It's not as saying these are bad areas, you shouldn't be invested in them. It's just offering you more choice. So if that's the choice that you want to take, it is there available to you. If you still prefer the multi-assets or the existing equity funds, they're also there for you. But hopefully by this time next year, they'll be on James's chart and have a lovely performancing as well, and that would be nice. But that's just a quick introduction. But if anyone's got any more questions, we're more than happy to answer them. Thank you and have a good Christmas.
Ladies and gentlemen, Katie Crook, the police force at Courtiers, and we've got another member of the police force in our audience, which is our compliance officer. So we've got to be on our best behaviour today. So in doing so, with intrepidation, I'm going to invite my colleague Gary Reynolds to the stage. I've worked with Gary for 33 years. I've been married 33 years very happily, and but slightly longer to Gary than to my wife Anne Marie. And the great Gary's an incredibly interesting man, and I have the great opportunity to spend Tuesday lunch times with him for a couple of hours, and we talk about different things like rugby and horse racing. Gary always reminds me when we're talking about investments about the 70s, because that's when he entered the industry. And for a number of years, many of you who attend the seminar and read the articles, etc., Gary's been talking about the disaster that's going to happen in the long-dated gilt market, which is basically when you lend your money to the British government, or T-bills when you lend your money to the US government. So Gary's been talking about that, and we've given him a nod, and we've said, yeah, and you're right, a stock clock is right twice a day. And so we're going to ask Gary to the stage, and Gary's going to tell us a bit about the 70s. So Gary Reynolds.
Thank you, Jamie. It's lovely to see everybody in person. Welcome. And I've got to say welcome to everybody that's tuned in remotely as well. So you get the theme this year is been very much about what didn't we invest in. There's been some bullets to dodge this year. In fact, there's always things to dodge. And I thought we'd kick off by talking about the types of things you never, ever, ever want to be invested in. And they come into three real categories: bubbles, liars, and leverage. And all of those will do an immense amount of damage to your wealth. So if you can avoid them, you can generally do okay. Buffett said, you don't have to do many right things in life, which is pretty good for us, really, as long as you don't do too many things wrong. And that's very, very true when you're looking at investments. So I thought we'd cover some. Here's a range of sort of things that have happened over the years. The history is littered with things that go horribly wrong. And you've had three really good examples this year of things blowing up, and we're surprised when they happen, but we shouldn't be. Disasters have happened for ages. The first chart on there on the top left goes back to Edward III, who destroyed the Florentine banks in the 1300s. He'd borrowed what would be the equivalent today of about 15 billion in sterling from two banks in Florence, the Peruzzi and the Bardi banks, and then he simply refused to pay them back. Now, we reckon Edward was a bit of a hero. He extended Parliament. He beat the French, which is generally what English people like to happen. Didn't happen in the World Cup, unfortunately, but there you go. But so he may have been a hero here, but he certainly was a villain as far as the Florentine banks were concerned. It caused a huge amount of problems. So more up to date, bubbles. This is, I'm going to give you an example of every one of these little things you want to avoid. This is my favourite. This is my favourite bubble period, the tulip bubble of the 1630s. Now, what happened around that time was a virus affected tulips. Not every tulip was worth a lot of money, but some were worth a considerable amount of money. A virus affected tulips, and so the tulips, rather than coming through as single colours flowers, came through as multiple coloured flowers, and these were a complete variation. Lots of very, very rich Dutch merchants thought these would be nice to have in their garden, in the same way that rich people like to buy a Rembrandt or some other work of art. Back in the 1630s, it was tulips that they were buying. If you are fortunate enough to have a tulip called a Viceroy, it was worth around 10 times the normal average salary of a skilled person. To bring that up to date, you could say it was worth something around 250 to 300,000 pounds in modern times. But if you were lucky enough to have the Scepter Augustus, which is the one you're looking at the screen right now, then that was worth 30 times the salary of a skilled person. So one of those things on the screen, I think I actually brought a prompt. One of these, if this was a Scepter Augustus today, and it was in the same value as it's worth in the 1630s, that's up to £1 million worth. £1 million. That seems crazy, but people are paying stacks for Bitcoin, and at least with a tulip, you can plant it and grow something. There's not much you can do with cryptocurrency when it's turned worthless. So bubbles happen. What is interesting is the downfall was intrinsic to the very thing that you put a lot of value on. One, people plant bulbs and they grow and they spring up other bulbs. So this all came to an end when the merchants suddenly realised that as they're going along to the market, they can see lots of these bulbs in everybody else's garden, which means they've lost their value. The uniqueness is gone. But the other thing is the virus actually weakened these things. So you can't get a Scepter Augustus today because they don't exist, because the virus weakened them and they died out. So bubbles come to an end. What will always destroy a bubble is when it becomes the item that has been pushed up in price becomes ubiquitous. So be very careful if you're putting a lot of money into something that can be easily replicated. Liars, you've got to, this industry, as Jamie said, I've been in this an awful long time now, but this industry is a wonderful place to work. You know, I'd always say to any youngsters wanting to come in, it's terrific. You meet great people. You learn a lot. You cover a variety of subjects. Fantastic. But it does attract the wrong people as well. Now, there's a very famous American bank robber, not quite as famous as the likes of John Dillinger, but this guy, Willie Sutton, didn't kill anybody, so he didn't become notorious. But Willie was a great bank robber. In the 1950s, when he got arrested, somebody said to him, "Willie, why do you rob banks?" And he said, "Because that's where the money is." And the thing with financial services, there's a lot of money hanging around. So it tends to attract some wrong people. And they can be pretty devastatingly wrong. Bernie Madoff, this is incredible. Bernie had a hedge fund that got to a peak value of about $64 billion. And unfortunately, the global financial crisis of 2008 caused a downturn in stock prices and people wanted their money back. Turned out that Bernie's 64 billion was a massive Ponzi scheme. In other words, there was no real value there. And if you ask for your money back, he could only give it to you if he gave the money back from the new investors coming in. But end of 2008, no new investors. It was reckoned he'd been doing this since the early 90s, but then one of his employees popped up and said, well, actually, Bernie was getting me to falsify accounts in the 1970s. So he'd actually built his whole career on this. 64 billion, it turned out about 12, 14 billion was recoverable. So he'd managed to torch his way through 50 odd billion over 20, 30 years. And there were big companies investing in this. Another hedge fund invested over 3 billion in its own right. So it conned people for an awful long time. You have to watch out. This is more recent. In fact, there's been some other examples this year. If anybody followed Theranos, Elizabeth Holmes, turned out that her brand new system for blood testing was a complete forgery. She raised billions of dollars to kick that off. But this is Sam Bankman-Fried. Sam was the darling of the crypto industry. Earlier this year, he was interviewed on a Bloomberg podcast, and he was asked to explain yield farming in terms of cryptocurrency. Sam said something like this. At the time, I was trying to get my head around this. I don't like crypto. Anyone has come to these before. Some of you I know have toyed with crypto, who's in the audience today, and some of you made money on it, Rob, haven't you? So, you know, if you got in and got out, good luck to you. But it was, I did try and get my head around it. Sometimes when you're investing, you've got to actually say, if I believe in this, can I come the other side and say, am I wrong? Or if I don't believe in this, can I go the other side and say, am I wrong on that either way? So I was trying to get into crypto, and I listened to this podcast specifically for this reason, and it just happened to have Sam Bankman-Fried being interviewed. So his description of yield currency goes something like this. Well, you have a box, and somebody puts something in the box, and then perhaps somebody puts something else in the box, and then from the box you pay something out. Because you pay something out, people might put more money in the box. And if they put more money in the box, more people put money on the box. Now, the box may do something useful, or it may not, but does it matter if it doesn't do anything useful, as long as somebody believes it does something useful? And I thought at the end of that podcast, I got it right. This is, you don't touch this with a barge pole. If you're unfortunate enough to have gone into this with young Sam, you'll find that the new 30-year-old future Warren Buffett was actually a complete crook. He'd managed to lend, he didn't seem to understand the difference between his money and his investors' money. So people had put their money onto his platform. He'd borrowed $10 billion of it into his own trading company, Alameda, made bad decisions with his own investments, lost all that money, borrowed more from his platform, lost that money, and eventually, just like Bernie Madoff, ran out of money. So you've got to avoid the liars in this industry, and they are around. And this is the other thing you've got to avoid: leverage. Most people in this room would have leveraged heavily at some stage because you would have bought a house. And when you bought your house, you would have got a mortgage, and that's leverage because you're using a lot of money to buy an asset because you can't put all the money together initially. So leverage is not necessarily a bad thing, but if it's excessive, it can absolutely destroy you. My favorite leverage story is this one: long-term capital management. 1998, these lot went bust. They were formed 4 years earlier by a guy called John Merriweather, who'd worked at Salomon Brothers. Merriweather was a bit of a trading star, but he'd had a checkered history because he'd left under a cloud because one of his employees had been getting involved in irregular trades. So he sets up long-term capital management. He managed to amass over 22 PhDs and 2 Nobel Prize winning economists. And initially they made a lot of money. They were 100 times leveraged. In other words, at their peak, they had one capital of $1, but they managed to invest $100 for every $1. The market turned wrong for them in 1998 when the Russian debt crisis came along. And it blew them up. They ended up losing about $3.8 billion. It wasn't fraud, it was simply leverage. Leverage will hurt you badly if you get it wrong. So there's a lot of doom and gloom around at the moment, a lot of doom and gloom on the UK economy, and people saying, you know, there's horrendous amounts of borrowing, government are borrowing too much. Is there leverage? If there is leverage out there, if there's uncontrollable leverage, we should be worried. If there's not, we have less to worry about. So, spoiler, the UK economy is not in bad shape at all. So this chart looks at global debt going back a few years, and the key thing are the black bars are corporate debt, the orange bars are family debt, and the red bars are government debt. And you can see the total debt has been pretty flat in the last few years. There's one little spike up there for 2020. And what you have to remember this type of thing is we're looking at a ratio. So to normalize things, so we see how much debt we've got relative to income. you know, that example I gave you of normalizing tulip bubbles was to convert them into, you know, multiples of salary, so we can compare today with 200 or 300 years ago. This one looks at debt to total output in the economy, GDP. And of course, it spikes a bit in 2020, not necessarily because debt was going up particularly quick, although it was going up a bit in governments, but because GDP drops. So GDP in this country dropped about 9% that year. And so your debt to GDP ratios change. But that's debt to GDP. If you break it down into individual elements, you can see that companies are not particularly borrowing a lot more. Families are not borrowing a lot more. Government is borrowing a bit more, which has been talked about a lot recently. There are some isolated instances, and this is an important one, where perhaps debt is running away a bit more than we would like. The red line on there is China. And what you can see is that China's debt to GDP has been racing upwards, so much so, in fact, that debt to GDP in China is now higher than it is in the US. Now, that may seem okay. You think, well, it's on a par. Yes, it may be on a par, but output per head in China is about 1/5 of what output per head is in the US. So China have fired their bazooka, tried to catch up with the West, but they've not necessarily got productivity up anywhere like is enjoyed in developed economies. But they have borrowed a lot of money, and you can see here it's not just although they're still regarded as an emerging market, it's not necessarily on a par with other emerging markets. Russia, Brazil, India are all pretty flat on total debt to GDP, but China is high. So we haven't got anything directly in China at the moment. We haven't had it for a while. I think it's quite worrying that you've got the Communist Party getting more and more involved in the economy, and history tends to tell you that communism doesn't allocate capitalism particularly well. If it did, then it wouldn't have been the collapse of the USSR that we were talking about in the late 80s and early 90s. It would have been the collapse of America, and that's absolutely, you know, that's nowhere near happening. And this gives you another good example in terms of the extent to which Chinese have been borrowing, because the bars show the change in the level of borrowing since 2010 as a percentage of GDP. The two bars on the right-hand side of that, the extreme one on the right is Hong Kong, but you can see next to it in China that Chinese families over the last 10 years have amassed extra debt equivalent to 100% of Chinese GDP. And that takes some going as well, because Chinese GDP has been growing faster than around the world, which means they've been borrowing more proportionately. So let's look at the biggest economy, the major economy in the world, the US. Have we got a debt problem there? No, not really. It's spiked a bit on the right-hand side, but that's purely because government debt has been going up because they've been bailing out the economy during the pandemic. So the red line there shows that debt to GDP from the government's perspective has been going up. Look in the same type of thing in the UK. Debt to GDP has been pretty flat post the global financial crisis, but you can see we've got a lot more borrowing from the government. But look at the black line and the orange line on the right-hand side, both coming down. Post the global financial crisis, families in the UK lost their appetite for debt. When we bought our first house in '81, my father said to me, "You just borrow money, it'll all work out fine. House prices go up." That was the thought process. And in fairness, you know, when years back, it was much easier to get borrowings today than it is for a lot of youngsters to get them. You know, the children, grandchildren are going to the bank of mum and dad for loans because they can't necessarily get the same amount of borrowing that our generation could get previously. But post-global financial crisis, we've all been a little bit more conservative. We've borrowed less, and so there's no element whatsoever of leverage within UK companies or UK families, households. So let's look then at where household debt stands, because this is actually a pretty good story. Household debt has been going up, so in absolute terms it's been going up. But what really matters is not so much how much you borrowed, it's what your net assets are. You know, if you've got £10 worth of borrowing and no assets, it's a lot worse position to be in than you've got £100,000 worth of borrowing and £200,000 worth of assets. So net household wealth in the UK has actually hit record levels. So in 2021, net household wealth, that's total assets of a family, less their debts, got to record levels. And if in terms of the level of leverage, households in this country, debt to assets is down to record low levels, just over 14%. So households, if I was a politician, you wouldn't dream of saying this, but you are as well off as you've ever been. So, and that goes for most other people in this country as well. If you look at it in absolute terms, I've put two figures up on the right hand side because this is a key thing. So total net wealth, families' assets, less debt, at the end of last year were 12.4 trillion. Before the pandemic, they stood at 10.84 trillion. So if we were prepared to give up the rise in the net value of assets that we've enjoyed over the last 3 years, that's during the pandemic, we would clear off the national debt, which perhaps puts the government borrowing into perspective, and perhaps why there was some merit in what Kwasi Kwarteng and Liz Truss proposed in terms of cutting taxes and getting people spending and getting some growth going again. So there is some basis for it. Now, there is one area of leverage. I'm just going to finish on this, and this is something to be careful of, because there is one organisation that has managed to get itself very, very heavily borrowed, and that's the Bank of England. Now, what you're looking at that is the total amount of bonds now owned by the Bank of England under a thing called quantitative easing. So if you cast your minds back to the global financial crisis, interest rates are slashed as banks fail, they get bailed out, and we all look and think, oh my goodness me, it's like financial Armageddon out there. But in those sorts of environments, you will not feel like taking on extra debt and spending extra money. So the economy suffers immediately from a dip in demand. To try and counter that, the bank will cut interest rates to encourage you to go and spend money instead of saving, and encourage you to borrow money. But it can only cut interest rates so far. And the other way it then tries to give a boost is to improve liquidity. Very important when banks are not lending. So in comes the Bank of England under Mervyn King and says, we will engage in quantitative easing. And over 11 years, they engage in around £430 billion worth of quantitative easing. You can see from left to right, little increases at different times. Now, the steep rise you can see on there from 2020 is under Andrew Bailey, when the Bank of England decide how they will deal with a pandemic that's going to shut the economy down. And what do? They do exactly what they did back in 2008, except the circumstances are entirely different. So this time round, the Bank of England more than double the amount of quantitative easing in 11 months. And that means there's this huge amount of cash washing around the economy. Problem, however, is the economy shut down. So you cannot spend all this cash, even if you wanted to. We probably were able to spend more than we expected to, thanks to Amazon. But generally, people are not going to go out and spend that money. So this lump of money sits through the pandemic until things start to ease, and then it's let loose. We want to spend more on services. We want to make up for the holidays we've missed in 2 years. We want to go to the restaurants we've not been able to go to. We buy more goods, even more goods. So there's a huge amount of demand that washes through this lump of cash, but we can't supply the goods and services to meet it. So you get inflation, and that's why RPI goes to 11.1%. Now, the key thing with this is, and one of the questions we get asked is, will interest rates go back down to what if there's another crisis? Will they get back down to 0.1% as they got to in the summer of 2020? Well, that's very, very unlikely for two reasons. One, because this is already in the system. If the Bank of England go on with constant QE, they'll own 100% of government debt if they repeat this into the next decade, and that's unlikely to happen. But in actual fact, they'll want to unravel this, which means rather than buying bonds, they'll be selling them back into the marketplace. As you have an oversupply of any asset, whether it's equities, property, bonds, it pushes price down. So that's likely to happen. So not great for bonds long time, but also because holders of long dated bonds saw their asset values decline up to 50% at one stage this year, they'll be much warier about buying and holding these things again for the future. So we saw this record low long-term interest rate in the summer of 2020. That's a 300-year plus low that we're unlikely to get back to anytime soon. So sum up. UK economy is in pretty good nick. It really is in pretty good shape. Families are in good shape. The pound probably got drastically oversold at 104 against the dollar recently. Overseas, people clearly think our economy is in good shape because they've been buying lots of British companies, like the ones that Jake has talked about, and that's all been very, very good news. What you still have to watch is long dated bonds. Even though they've collapsed in price this year, that's not an asset that you want to be running back to. So that's the same sort of message from me that I've given in the past. And then finally, with regard to all that other stuff we talked around, just always, there's another, Jake quoted Einstein, but there's a lovely thing that Einstein said, and he said, if you want your children to be intelligent, read them fairy stories. If you want them to be more intelligent, read them more fairy stories. Now, there's a logic in that. Lots of these myths and stories contain the kernels of wisdom that get handed down in the stories. And I've thought about this quote for quite a while, and in particularly this year with these scams that come along, because if there's one fairy story you should teach your grandchildren and children, it's the emperor's new clothes. Because if everybody's screaming what a wonderful set of clothes and all you can see is a naked man, he's probably naked. So don't buy the asset. I think we're going to do Q&A now. So if there's any questions you want to ask, please write them on the cards. We'll be around at lunch. So if you get a chance to have a chat, that would be nice. If I don't get a chance to talk to you, have a great Christmas. And let's hope James gets his wish for a very boring 2023. Thank you.
Ladies and gentlemen, Gary Reynolds. We're here for the question and answers, and now, so thank you so much for how many questions that we've had just from the physical audience here today. Thank you very much, and from our virtual audience. So, James, if I may turn to you, you mentioned about inflation, and you mentioned about rising interest rates. How does inflation affect equities?
So one of the effects it can have, if inflation is rising and companies are having to spend more on materials, for instance, and that can impact their earnings, unless of course they can pass on those price rises to the customers. That of course could impact the amount they're able to sell. If a product becomes more expensive, fewer customers may want to buy it. So it can have quite a negative impact. But the other reason it can be negative is because when inflation rises, interest rates rise typically as well. And when rates rise, the discount rate that you apply to a company's future earnings increases. When the discount rate is higher, the present value of those future earnings is lower. So you see the technical valuation of a company also go down because you're having to apply a higher discount rate to all of those future earnings. And the price of a company is essentially the present value of all of those future earnings. So higher inflation and higher interest rates tends to have a negative impact, all else equal, on company valuations.
Jake, if I may, can I pick up on that earnings that James just mentioned? I think, am I right in saying that you're reasonably bullish about the UK stock market?
Yeah, so we constantly look at fundamentals of markets. That's what we use. You know, you said it a couple of years ago that in the market in the short run is a voting machine. In the long run, it's a weighing machine. Finding that weight, finding your earnings, your assets, your dividend yields, all these fundamental anchors. And particularly in the UK market, some of the charts I presented, the sort of SMM, each month we have to hold like sort of the investment team to account, and we put loads of metrics out. But I put these fundamentals charts in just to show how attractive the discount is on UK. Partly the reason why we saw those companies being bought by foreign companies. See UK companies being bought by foreign companies is because the discounts are very strong, and it's got to the point a couple of months ago where the fundamental value in the market was as low as it was high, because you're buying cheap, but it's more attractive when it's cheaper. It was at levels that we'd seen in March 2020 as earnings have recovered, but prices are still lagging. Even in the FTSE 100, it's had an amazing year, but earnings are absolutely huge. So it's really looking like a good entry level to markets.
Okay, that's interesting. But you mentioned in your talk about double kicker.
Yeah.
What is a double kicker?
So the reason we try to hedge obviously is to stop the assets going down to foreign participants. But if you're a foreign participant and you buy an asset and then the pound recovers back to levels, pre-2008, it was $2 to the pound. If you went back up that level, let's just go back to James's chart, the bottom of the USD GBP exchange rate. So how the price of a pound in dollars, it was getting down to $1. If that goes back up to $2, now I'm not saying we'll get back up to that level, but you get 100% return just on the asset could not even go up. And then you get the 100% return just on the FX, because then you go and sell it and you buy your currency back. But also if the asset is undervalued, not only would you chase down that discount on the asset, then you would also expect a return on the currency. And that's why we're hedging. The multi-assets are hedged at the moment on GBP, because we don't want to be the other side of that.
Okay, Gary and Katie, if you don't mind, I just will come back to you because I've got a fantastic question from Phil Blundell that I want to ask you. Jake mentioned about the sterling dollar relationship, and are we saying sterling's undervalued at this point and potentially there's a lift?
Well, we put a note out when it hit 104. And I can remember the 80s ago. I remember the 70s and the 80s. But when everyone talked about the pound getting to parity with the dollar again, but we do tests in the office. Sometimes the simple things to do is to look at how much it costs to buy a particular good in New York, as it perhaps does locally. If it's significantly cheaper locally than it is in New York, then the theory is that your currency is undervalued. Jake put a piece out then, and we got very bullish sterling, which meant we were ditching more dollars in the portfolios because they'd had a good run, and then sterling bounced back up to it's about 122, 123 today. So, but that's still we still think that's undervalued.
So what do you anticipate? If I've got my $1 and I'm going to New York and I want to buy some Big Mac chips, what are you expecting me to pay?
So I think the UK is in a much better place than people think it is, and I think that'll be reflected in the currency and this is video, isn't it? So I'm really making a rod for my own back. So I think we'll be here next year with sterling through 130 against the dollar, and with a picked up UK stock market.
Okay, I'm going to move on to this question to you, Katie, but I am going to come back to you, Gary, because you seem in a very predictive mood. So a question from Phil Blundow, and Phil is the Managing Director of Air Tanker. Does it remain ethical to exclude defence instruments from the E Fund, bearing in mind the current situation?
I mean, we've had that discussion amongst ourselves when we were constructing Eve. It was, I think this started back in January, so February was around the time that the Russian-Ukraine conflict all kicked off, and there were lots of companies saying, oh, well, you know, they need to have armaments to defend themselves. But the thing is with Eve is we have to weigh everything up, and we know not every single area is going to suit everybody's, you know, personal beliefs, because ethics is more moral personal beliefs than it is sustainability beliefs, which is where our fund is slightly different. And I think if you were to weigh it up on the basis of whether most of the people who are currently in that strategy would want to see armaments reintroduced, I could comfortably say the general consensus would be no, which is why we haven't excluded them from the multi-asset funds, but we wouldn't feel comfortable putting them in the E fund just due to the amount of backlash we think that would have. It's not us saying we don't think they're ethical or unethical investments, but just based on the client base that is in that fund, we can comfortably say it would align with the majority of their views, and that's why they've been excluded.
Thank you. James, you mentioned Shell in your presentation. Do we like Shell?
Well, Shell is currently in the UK Equity Income Fund, because it's been chosen for the fund based on its value characteristics. And as the UK fund doesn't have any ethical constraints, we're more than happy for it to be in the fund. Also, the multi-asset funds also have exposure to it simply because it's got such a huge presence in the FTSE 100 index, and also the Stock 600 index, which is a European index as well. So we're quite happy to have exposure to Shell. If it starts flagging in our value screen as being not so good value, then there's no reason why we wouldn't sell it and replace it with another company.
Okay, so it's a fundamental decision, effectively. Yeah. Jake, interestingly, I was told a story yesterday, and I'm reassured that it was true, that a professor of geology each year gets up in front of his students and basically says to them, who would like to work in the gas and oil industry? And 5 years ago, you'd have 90% of the students putting up their hands. This year he did it, and it's Oxford University, by the way. This year he did it, and there were 5% of people put up their hands. And he said to other people, and who would like to work in the renewable industries? 90% of people put up their hands. And he said, excellent, so you'll be working with Shell after you've been here then. So how big is Shell in renewables? And I'm no way promoting Shell here.
Yeah, without there's no bigger incentive for Shell to invest in renewables than to try and live on. It's the biggest existential threat to them. Whilst a lot of their business is still oil and gas, they are putting up billions each year to invest in renewables, and that's obviously is going to be, they'll want to go into research, and that is who's going to put the money up. So, they will all be working for Shell or entities funded by Shell, because they want to be at the forefront of the next technology that will ultimately that will surpass oil and gas. Daedalus is a good quote. The Stone Age didn't end for a lack of stones, and the oil age won't end for a lack of oil. And so they've got to make sure whatever is going to replace that will they'll be ready for. Shell is very diversified. It bought BG Group in 2015. It's near down here, the headquarters down in Reading. And so it's got a big exposure to gas. That's the way it was going for the last few years, and that's movement to gas is a reason why we've been able to get our carbon emissions down so much. So that was one big step they took years ago, and now they want to continue to invest in other technologies such as hydrogen and other ways, and offshore wind and onshore wind, and even they're providing broadband and energy now. Their energy provider is completely renewable, so they don't actually use any of their oil and gas components of their business for their energy providing that's purely renewable. So I think on average, about 39% of the UK energy mix is renewable, whereas if you get your energy from Shell, they can cover that with the amount of renewables that they are owning. So that's 100% covered. So you'd be actually more renewable if you were Shell Energy.
So the actual so-called fossil fuel, they're actually some of the biggest investors in renewable.
Yeah.
Okay, so that's interesting. After the Armand's question, why haven't we got Shell and Eve or BP and Eve? They do so good for the world.
One Steve over there would be screaming at us for not sticking to the investment mandate in the first place, but there's been a lot of news over the last 12 months about where funds have stuck the word sustainable on their fund name, and then their investors get some nice letters about 10 months later being like, oh, did you know 60% of your fund is in oil? And they have a bit of a heart attack. We were very much, okay, this is what the existing ethical strategy does. We want to do it ourselves, but we want to do it so that we've got control of the holdings and can make sure everything fully aligns with that strategy. We weren't going to take any of those exclusions away. And because fossil fuels were excluded in the original strategy, we've remained having them excluded in our own strategy. It's not like Jake said, you need something to fund the change, but at the moment they're not in a place where they are 100% renewable. If we're talking 10 years down the line and they're only doing renewable, yes, they could go into the fund, but at the moment, because of the allocation to the fossil fuels, they won't be going in the fund anytime soon until they have no exposure to fossil fuels.
Okay, so it's a screening process.
Yeah.
It's not a value or fundamental process, it's a screening process.
It's on that exclusion screen and it says it in the screen, it's not going in the fund.
Excellent, excellent. Gary, UK corporate debt is down, but do we not want this to rise? So companies are investing more money to improve our productivity.
Absolutely. This is that's a very simple non-brainer. It's been down. It's been down for sort of peaked off 2016, and its level of investment has not been picking up as it needs to make us more productive. So we're not getting a boost in the economy in terms of productivity. We're not getting it so much through immigration from Eastern Europe now. So where are we going to get it from? I think that's a question you have to think about. I think there's lots of opportunities. Anecdotally, I can think of people I know that own good businesses that simply cannot get the staff to deliver on the demand. But that actually does mean it forces the company to think of other ways of being productive if you can't put extra employees on. So that might boost them. This strange things happen sometimes. That might boost investment in productivity, because it's not easy just to go and recruit somebody these days, not with unemployment at these very low levels. We're out of the EU, you can't bring people in from Europe as easily. So perhaps that will be a boost. We do need a boost. I mean, the level of investment has been pretty poor.
So interestingly, we all experience these challenges in the employment market. So have we lost many workers since Brexit? Or?
Yeah, we've lost about 600,000 people to the workforce. So we got a job for everybody that wants one in the UK. So unemployment and vacancies match. It's not, or in times of deep recession, you can have 10 people chasing one job. We haven't got that at the moment. Obviously, not everybody can be matched up because it depends on the skill set. What type of job is available. Somebody needs the requisite skills to go and do it. But we seem to have lost a number of people who have decided they want to be what the statisticians called economically inactive. In other words, they've chosen not to go back to work. And if you add the totals up from that, including people that have opted for early retirement, people on long-term sick, you get to something around 600,000. A lot of people from the EU, the number of EU workers in the British worker is dropping. So we're not replacing them at a particularly fast rate. So that's having a change. That's in fairness, it is easy to say. So if you read some of the commentators, I like David Smith writing in the Sunday Times every week, but David Smith is very anti-Brexit, and I put my hand out. I did not vote for it, but then again, you respect the democratic choice. But he makes the point that there's been a decline in investment, and there's a lack of people since 2016. So that could be true, and there's a problem with a tight labour force. But in America, you've got 1.7 jobs for every unemployed person, so they're booming, so it's not. I am studiously trying to avoid criticising either Brexiteers or Remainers, because we got both in this audience today, and some people feel very strongly about it. And I just want to enjoy my Christmas. I don't want to round a season of goodwill. So on balance, however, I will say that short term, Brexit has hurt the UK economy, and in the long term, it could be very beneficial, particularly if we decided to become more open for tariffs and things, and we get to more free trade. But it's not to say that will go on. The unforeseen consequences tend to sort of occur, and they can happen very quickly. So we might get some nice surprises from this, and we might find if there is a pickup in investment.
James, is productivity key for the UK economy?
It is the sort of thing we always look out for during those sort of spring budgets, autumn budgets. And the UK, you often hear it quoted, the UK has relatively low productivity compared to a lot of the other major economies. And as Gary alluded to, the impacts of Brexit has possibly harmed it. But yeah, I'm with Gary in that it could yet improve, so fingers crossed.
And James, regarding inflation, I'm going to come back to you on that, because I'm going to hand this question to Jake. Jake, regarding inflation, how high do you see inflation going, or have we peaked?
I think we've peaked, but I don't see it going back to really low levels just because of the tight labour market that Dan alluded to. And there was something that came out this week with economists that we read a lot of work from, Dario, and everyone's talking about, is it going to be a soft landing, is it going to be a hard landing, is inflation just sending a drop and then everything's going to be volatile again, or will it come down slowly and civilized and then go back to its target and everyone knows what's going on? And he said, well, what about no landing? We just have slightly higher inflation for a while until we sort out our issues, until we can sort out energy markets, until we can sort out tight labour markets and supply chains, and that could go on. It's already been going on. It was meant to be transitory. It was meant to come back in 2-3 months, and that was over a year ago. And it just tends to be quite persistent, and it's just going to take some time to come down. So I think next year probably is going to settle between 4 or 5%, and then hopefully in the future we'll get it back down to target, but maybe tail end of 2023, 2024.
And Katie, the price of the cost of energy, is that good for the renewable market?
With the renewable market, it's more, I would say, an efficiency issue. So if they can get the, solar panels from 20 years ago to where we are now, the output that they create is massive compared to where you were. And also, if you've seen the original solar panels are about this chunky, and now you can get them on a boat the size of a piece of paper. So if they can get those more efficient, which actually on par, solar is catching up to nuclear for efficiency. you get that more efficient, the price will come down on it. So it's more of an efficiency issue.
Okay, that's interesting, Keith. You brought the word nuclear up. So do we invest in nuclear? And if we don't, why don't we in Eve?
So I checked this with James earlier. I think we don't have any direct exposure within the multi-assets or the UK or global fund as far as I'm aware, but we wouldn't put it into Eve. And it's not because we don't think it's clean energy. It's more, what do you do with the waste that comes off the nuclear energy? There's so far no way of getting rid of it. They've tried burying it. They've even contemplated shooting it off into space. But as you've all seen with Chernobyl, that doesn't go away and nobody's moving back there anytime soon. So until they can come up with an actual way to get rid of the waste that's not going to cause any further environmental or social harm, it's not something we can class as an ethical investment for Eve.
So a lot of time, Gary, the commentators talked about China, but you didn't seem that enthused about China. Is China a no-go area for investors?
I think you'd never say entirely no go, but you'd have to try and find very good reasons to invest into businesses in a country that's becoming increasingly authoritarian, and with a government that is increasingly getting involved in the way in which its key businesses operate. So Xi Jinping is turning the clock back. I mean, China moved on, particularly under Deng Xiaoping, it moved on from Mao and became more open. Xi Jinping is taking it back, no question. He's taking it back, and therefore they're putting undue regulation on their tech companies, getting the comment, it's okay to get rich first. In other words, you could, if you get wealthy Chinese business people make money and then it goes down, which is certainly a US view of an economy and business. Xi Jinping stamped all over that. So even if you do put money into something and it does very well in China, you don't know whether the man or woman from the ministry is going to rock up and just nationalize it. So, or probably not that, but putting the communist commissar onto the board to give advice on what isn't acceptable under the moral theory of the Communist Party. So you would be very wary about investing, I think, directly in China at the moment whilst it's going in this direction. And I don't think it matters because there's stacks of great opportunities outside of there to look at. And as James Shaw, I think, was China off 28%, James, it was that was a good place to be out of last year.
Okay, well, it comes to that time of year, James, where we're both sat in front of the fire. We've hung our stockings on the fireplace. We've got our pen and paper in our hand, and we're writing that letter. And we've got Bing Crosby in the background playing One Christmas. So we're writing our letter to Santa. What's going to be on your wish list?
Well, I'm not sure that letter would go very far at the moment. But I'm going to make the same wish that I made last year. It would be nice to see volatility go back to lower levels, not just because it makes our lives easier, but also because when volatility is lower, options become much more affordable. And one of the things we like to do with options is to insert some protection into the portfolios. But since the outbreak of the pandemic, the cost of those options has been so high, and it's stayed high for nearly 3 years now. So we'd love to see volatility come right back down.
So, Jake, I'm going to say the same to you, but I'm going to have a caveat with all the rest of the panel. You can't repeat the same wish. It must be a different wish. Because we can't all get bikes for Christmas. So, Jake, what is on your Christmas list?
Yeah, so you talked about that double kick, that the equity market's being at a discount, you know, the super expensive tech stocks, some of them have come down. There's still a record spread between the cheapest and the most expensive stocks in the market, even with the quite defensive year we've had. So if that got closed down, the portfolio would be positioned really well for it. So if that were to happen, particularly in the UK, but across the globe as well, a normalization of the spread between the cheapest companies and the most expensive companies back to average levels would be really, really positive for the fund. And I think we performed really well in that environment. So I'd really would like that to happen.
Lovely, lovely. And Katie, can I turn to you, please?
Well, I think first of all was Eve would do amazing, and then it'd look wonderful on James's chart next year. But mainly that the FCA, probably after the amount of time they've taken, finally sort out their UK equivalent of sustainability fund labelling. So when you guys are looking at things, it's not just, oh, we've put that in the name, that's really good, in an actual understandable manner, rather than we can put whatever label we want on which fund. That's completely meaningless. So hopefully after 3 or 4 years, they might finally finish it this year.
Excellent. And for yourself, Gary?
I can tell you what my wish is. I am wishing the pound is above 130 to the dollar. I'm in trouble.
And can I just do a UK equity market, up or down? Up. Jake?
Up.
Katie?
Up.
Gary? Up. Why?
It's cheap. And UK is going to do a lot better than everybody thinks. You get surprises both sides. You've had 2 years of nasty pandemics, wars. You'll get a surprise in the other direction at some stage.
So we're going to have a very good UK market. Inflation is going to come down to 5%. And Gary, interest rates?
Interest rates they'll be down. They'll go up and then they'll stabilise. You've had 2 people vote to keep them the same on this rate round. One wants them up by 0.75 and then the rest of 0.5. So long-term rates they'll be up a little bit, but I think base rate is going to be okay.
We're going to re-record in a sec, aren't we, with the other?
Ladies and gentlemen, that brings the end to our seminar, and may I thank everybody here in the audience today and everybody viewing in from home. And can I wish you all a very, very Merry Christmas and a Happy New Year. And thank you.